So welcome back to the podcast. I'm excited about today's podcast. I'm here with co-host Jared Wilson, and we have a very, I think, unique and special guest with us today to talk about something that is not talked about a lot or enough in the strength coach industry. And this is something that Jared and I had a conversation about last week, and we thought we'd bring Nick in and talk about the financial side of things as far as being a strength coach, whether that's in the private industry or whether that's in a college setting or in the university setting or even the high school setting, about strength coaches and what they should do with their money, or how they should plan their taxes, or how they should plan to set themselves up later in life for retirement and investments and other things. And I think it's a little bit taboo to talk about this as a strength coach because you want to say, oh, it's not about the money, it's not about the money. But you have to make money to live and to eat and to provide for your family. So I'm excited to introduce Mr. Nick Pantuso in on our podcast. And can you give us just a short intro on who you are and what you do?
Absolutely. Appreciate you having me here. Both of you guys have trained me. He was a little less gentle than you, but he put me in my place, which is what everybody needs. So I live locally, husband, father of two. Everybody in the family's an athlete. I am a recovering CPA. I got my CPA license back in the late 90s. I say recovering because I just don't practice anymore, though I'm up to speed on financial law. Have a real estate broker's license. I've had that for 20 years. I have a NMLS lender's license nationally, though I'm only licensed currently in the state of Texas and California. And I hold 4 securities licenses. I have a 6, 63, 65, and 66. So people put labels on what you do. To take one of Jared's lines, I'm just a finance guy. I understand finance. Everybody understands finance. I think where we get overwhelmed is finance is 8th grade math and discipline. Everything that I do as a CPA, real estate broker, investor, manage monies, retirement accounts, qualified, non-qualified, it's all 6th grade math. Doctors, engineers, scientists, they have the higher level math, but it was 8th grade math when I did it. Your kids, it'll probably be more like 6th grade math. So,
yeah, cool. Well, thanks for your introduction. Sure. I wanted to just kind of get the discussion going with an article I found online, and one of the only things I found online in regards to managing your money as a strength coach. It was a blog on Team Builder that I found. The author, and I hope I'm not mispronouncing his name, was Carmen Pata. Excuse me if I'm mispronouncing your name, but I think it's one of the only things I found, and I think it'd be a good way to kind of get the discussion started. So I'll just read a short bit here. It says, first things first. I know you're all coaching for the right reasons. Either you want to give something back, or you're trying to make a difference in people's lives, or you're trying to leave a program better than the way you found it. I know these things because those are the reasons I do what I do, but you can't pay your rent with good intentions. So like it or not, you have to start being smart about the way you spend your money, which means you need to start planning on what you're going to do with each paycheck. And so, again, I haven't found a lot of information online or any resources on strength coaches in particular on what they should do with their money. So maybe if you can kind of give a response to that, and then we can kind of get a discussion going.
It's interesting. He uses the word spend. And I don't think people look at things this way, but maybe if you take the first 10% of whatever you make and invest it, and then spend the remaining on how you have to live or you want to live. Pay yourself first. And I don't think most people pay themselves first. They think about paying Verizon or the landlord or the Amex card, whatever. Pay yourself first. And so maybe the habit of changing the vernacular a little bit from spending your money to investing your money might be a way to start the process, change the mindset a little bit. It's not unlike most industries or most people. Most folks will not invest in themselves for the long term. And you'd brought up the taxes. So advice right off the top. Set up payroll. Go through ADP because you're both self-employed, right? You don't have jobs. You're 1099 guys or Schedule C guys. Set up payroll. Put yourself on payroll. Put your wife on payroll. Put your kids on payroll. You do the same. Put your wife on payroll. Pay your kids $6,000 a year. $500 a month, okay, they don't have to report that. But your company gets to write it off. And you can do 529 plans and things of that nature for education for them in the future. But put your family on payroll and just, like if you have 4 kids, take $24,000 as a tax write-off. Because the money just goes from your business account to your kid's checking account. And in 18 years, maybe that pays for their college education. And it was tax-free.
Right.
Simple things. So talk to your CPA. Tell them you want to put the wife and the kids on payroll immediately.
I think even to take a step back, I don't think a lot of strength coaches even know how to set up a business, how to set up an LLC, how to set up a sole proprietorship. So Jared and I talked about this on our last episode. Was when we first started this, we didn't know any of this. We didn't even know to do that. I mean, we kind of knew the basics, but we didn't know that you had to set up maybe an LLC or an S corp or sole proprietorship or even the benefits of doing that. So can you talk on that a little bit, and then maybe that adds to your point about maybe putting your kids on payroll or things like that, because I think strength coaches don't even know.
Before you go, sorry to cut you off, is like my experience was I was a 1099 guy, right? Everyone that I knew growing up was a lot of W-2.
Sure.
So they take your taxes out for you.
Right.
And I have a lot of buddies, when you start, you get this paycheck. You're a 21-year-old kid, you get $4,000 a month when you start. You put no money away for taxes because all you know growing up was a W-2.
Yeah, your net check.
Your net. And
Right.
they're taking the taxes out for you. And all of a sudden now the end of the year comes and the government comes knocking, they're like, hey, you owe us $20,000.
Right.
And you're like, that's like my whole bank account. I mean, that's stories that I've heard of, and guys or they didn't put enough away. They didn't understand how much they should actually be putting away for just taxes.
Right.
Is where, that $4,000 check looks good when you're a 21-year-old guy that's, wanting to go get some beers with your friends, but all of a sudden you're blowing through all your money that you might have to give to the government at the end of the year. Because we don't pay our taxes the way that a W-2 everyone else does. Yeah, exactly.
Yeah. Again, we're going to talk about 6th grade math. If you make $1,000 a month, take $333 and put it away for taxes. Just take a third. We're simple math. Take a third and put it away for taxes, because you're going to. And let's go with the caveat that a lot of strength coaches or personal trainers who are training folks, that money's cash and they're never going to report it anyways. Okay, so bifurcate that, and we'll just go to where you receive a 1099 from a large facility where you're training. Whatever that number is, happens to be $60,000 in a year, take $30,000 or $20,000, put it in the bank, and live off the rest. When you are self-employed, you have to pay. If you've been W-2, you know that you have Social Security taken out of your paycheck. Most people don't realize that the employer matches that Social Security with this exact same amount. When you're self-employed, you get to pay both of those. So it's 15.3%. It's not 7.65.
Yep.
Then you have, Uncle Gavin Newsom that wants his piece and Uncle Joe Biden that wants his piece, and you have to pay the Fed and the state. If you're lucky enough to be in a Texas or a Florida or Tennessee where you don't have state income taxes, then so be it. For most sole proprietors, what I will tell you, and I have a colleague that has a very large book of business, he doesn't have an LLC, doesn't have an S corp, doesn't have a C corp. He's got a Schedule C on his tax return. We've all filed taxes. So you have your 1040 and you have your Schedule A with your itemized deductions. You have your Schedule B with your interest and dividends. And then you have your Schedule C, which is your business, whatever it may be. Mama's Sewing Company or Lucas Quinn or Jared Wilson, whatever your company is. And you have no license. I mean, you have your professional licenses, but you don't have an LLC license. You don't have. Just set up a simple C corp or Schedule C on your tax return. Keep it simple. There's no reason to complicate things. As you begin to grow, if you want to insulate yourself from some liabilities, then maybe you're going to go down the road of an S corp or an LLC, limited liability company, and leave it all in the company. But if you do that, and even if you run your own Schedule C, set up payroll and get everybody on the family on payroll. Once the kids turn 18, keep them on payroll if they're going to go to college. But at 18, now you can also set up 401ks for the kids or IRAs and start them on the plan to a future that is more pleasant. Because I think what we're talking about here is doing what you love to do and making what you love to do your career. But I don't think enough people are looking to what's it going to be like when our bodies start to break down.
Right.
And you're 60 years old, and you really don't want to keep training because you have, 2 beautiful sons and a beautiful daughter who have given you 6 grandkids. You don't want to say, I can't go. I've got, we got to pull chain today, or we got to push sleds today. No.
Right. There's a running joke in the strength coaching industry that Jared and I talk about is strength coaches don't have retirement parties. And you hear that a lot. So I think that's kind of to your point.
Totally. So it's the dig your well before you're thirsty philosophy is mine. And I think what folks have to do is there's 3 things that should occur. One that will occur. You build a habit. Just build a habit. Start it. Build it as big as you can the first year, as uncomfortable as you can the first year. And if you don't do those 2 things, then you will retire broke. And I hate to use that 5-letter word, but it's the real deal. 90+% of the baby boomers out there today are broke. They're going to retire on some kind of Social Security, and maybe they've got $500,000 in the bank. Well, if you're 60 years old and you've got 25 to 30 years to live, $500,000 is going to go fast, especially with inflation. So go to Costco today and get the 60-pack of eggs. I think it's 60-pack.
Yeah.
And they have like a 3-pack of organic milk and a 5-pound block of cheese. And just today, put it on your phone, whatever those cost, and go back next year and tell me if it costs any more.
Yeah.
Because regardless of what's coming out of Washington, those things are going to cost more next year.
I mean, it's crazy, but kind of touch on what you're saying a little bit is maybe to go like some more advice, I guess I would ask is for like a young strength coach that, for example, my first year I say is like I made like $38,000, right? So like you're talking about the habits, how to get started. What would your advice be for someone like that maybe is not making a ton of money, but how do they build those habits? Maybe kind of, is there a better place to put their money? Do they just save their money? Where would you kind of like go with that?
So let's say a young coach is going to make $36,000 a year, right? 12 months is $3,000 a month. Let's keep the math simple. In that particular case, I don't think 1/3 of that income is going to need to go to taxes, right? Probably more like 20% will need to go to taxes. But so I would say to that individual, let's just say they're 22, right out of college, at least start off with $100 a month. And if you want to get real gutsy about it, in year 2, make it $200 a month. So that by the time you're year 10, it's $1,000 a month. And by the time you're 15, it's $1,500 a month. You're doing this thing for 20 years. You're now 42 years old and you're enjoying it, but you got kids, you have a wife, you want to enjoy other things in life. I mean, now you're putting $2,000 a month away. I can't tell you what that number is going to be in 30 years. I'm going to guess it's probably going to be somewhere around $3 million-ish at a good return. But $3 million 30 years from now is probably going to be worth about $1.2 million. And $1.2 million, even today, if you had $1.2 million, it's not going to be a fat retirement. You're going to take out maybe 4% a year. 4% on $1.2 million is $48,000. That's $4,000 a month. So you want to retire on $4,000 a month in Social Security? Dude, you better not blow any tires or lose a water heater or radiator goes.
Yeah.
So just start. Again, if you can start a habit as big and nasty as possible, when you get to your second year, and let's just say you're fortunate to start build a business and you're going from 36,000 to 48,000, but you started off huge the first year, then that extra 12,000 is $1,000 in your pocket. The habit's set. That money is yours to spend. But if you start off, $100 and then you get $1,000 a month raise, are you going to be disciplined enough to put another 100 away?
Right. And what do you mean by away? Is that just savings? Is that investment? What do you mean?
I would start it all as soon as possible in a qualified account. Qualified meaning it qualifies for tax benefits. Keep in mind, 401ks and IRAs are not retirement accounts. 401ks and IRAs are not retirement accounts. They are savings accounts with tax benefits that you can use to age 59 and a half. And it has been sold, and the propaganda is such that it's a retirement account. Pensions don't exist hardly anymore unless you're a civil servant, more than likely a school teacher, firefighter, police officer. They are savings accounts. So you have Non-qualified, they don't qualify for any tax benefits. We make some money, we put it in our Wells Fargo savings, boom. Then you have the qualified, where we make our money, put our money in our Wells Fargo savings, and then take that money and put it in a qualified account, which we'll call propagandize, we'll call it a retirement account. Start that now. If your income is low and you may not pay much in tax, I would tell you do a Roth IRA. I've set up plenty of them. A Roth means you pay tax on it now. And if you're at the 8% tax bracket, great, we'll pay tax on it now. You put this $100 away, 30 years from now, just this $100 is worth $1,500. When you draw that out, it's 100% tax-free.
Right.
Pay no taxes. If you got bigger numbers and you're making more income and you are not self-employed and the company offers no 401k, start an IRA ASAP. $6,500 a year. It's going to be $541 a month, I think. Start that habit. If you are self-employed, there's a SEP IRA, self-employed IRA. You can do up to 25% of your income not to exceed $62,000. And that's the big daddy. Because if you were rocking a business, this is not your strength coaches, this is a small portion of the strength coaches, right, and you're making $500,000 a year, you put your wife on payroll for $250,000 and you're on for $215,000 combined, you guys put away $124,000. Okay? But if you're a coach, you're self-employed, and maybe you're making $60,000, the traditional IRA is only going to let you put $6,500 away. But if you had a SEP, 25% of $60,000, you could put $15,000 away. So start the habit. Start now. Get after it now. The longer you wait, the more difficult it's going to be.
So what about a strength coach who's 38 who has done none of this? What would you recommend in that case? Which I'd be willing to bet is a lot. Or 42 or 46.
Probably making good money. If you're 38, 40 and you're still strength coach and you're still busy, you're probably making pretty good money. You're not in the 36 anymore. You obviously have a business because you've probably done it from a lot of strength coaches I know started when they're 18. So you've done it for 20 some plus years, and maybe you just have never looked at this or have never understood it.
Book of business.
Yeah, good book of business, but the savings and what you're saying, they just haven't built the habit or whatever. How can they start? Because they might hear this and say, man, I'm 40. I'm only 20 years away from 60. And I'm like, man, what am I going to do? I can't put just $100 away.
Right.
Even $1,000 might feel, a little short at that point.
It's going to be way short.
Yeah.
It'll be way short. And you know what? That 20 to 60, that comes really fast. I am almost there. So somebody in their late 30s, married, not married, maybe has a house, doesn't have a house. Let's assume they don't have a house. Everything I just talked about with qualified accounts, let's bifurcate that and put it aside for a second. Buy yourself a duplex. Spend whatever the number is. California, $600,000 on a duplex. Do it with an FHA loan, 3.5% down. 3.5% of $600,000 is $21,000. So put $21,000 on this place, plus your closing costs, you may need $32,000, and move into this duplex. And let that tenant pay your mortgage for you. That's, at that age, 100%. You may be somewhere in Texas, and that duplex is going to cost you $300,000. $300,000 at 3.5 is 10.5. So now you need 10.5 plus your closing costs. If you're at that age, what I would tell you is housing. If you go to Maslow's hierarchy of needs, it's critical. Self-actualization is top of the pyramid. It's not necessary. Safety and security and income, it's not necessary. Loving, belonging, being part of an organization, feeling accepted, not important. What is important is air, food, water, and shelter. That is a need. The other things make you a well-rounded human being. They make you a person that other people want to be with, they want to grow with. They make you grow. It makes you grow personally, but it's not necessary. What is necessary is air, food, water, and shelter. So you're 38, you're 40 years old. You've got nothing. You've got less than 100,000 in qualified accounts. Buy yourself a duplex or a triplex or a fourplex. There's nothing wrong with that living. And if you continue to rock your business, after a year or two, you save every penny you can. Then you go buy a house, and then you let two people pay the mortgage for you. Because in 20 years, here in California, if we're talking about Newbury Park, a duplex, a 2-bedroom, 1-bath is going to rent for $2,800 a month each. So that's $5,600 a year or a month. 20 years from now, that's going to be 10 grand.
Right.
And the mortgage is going to be paid down by somebody else. And what did you put into the deal? $35,000. That's my number one advice. So I'm very big on breaking away from the securities thought process and buying real estate, then buying the house, then maxing out what you can put in your 401ks. And if you can get that habit, then you're going to be in a significantly better position than I would say 98% of your colleagues. Like 98. That's not fear-driven. That's just fact.
Right. Yeah. Right. I think the median income for strength coaches, I looked it up this morning, it was 38 to 64. Now, there's private industry strength coaches that are making a lot more because they're doing online business and they're doing a lot of other things. But like you said, 98% of strength coaches, they're not making $750K a year. They're just not, you know. What would be your advice for a younger strength coach who's just getting into it? What would be the first thing to do? I know we already talked about it a little bit, but do you have anything to add to that?
Well, I would tell them, start the habit from the get-go. Start and go big. And work 16 hours a day, 6-7 days a week. Get after it. You're young. Go get it. And once you've developed that habit and you've got $1,000 going away every month, or maybe you're married or you have a significant other, each of you got $2,000 a month going away, get after it. Build a habit and build it big. And build it early. That's what I tell everyone.
Yeah, I mean, we talked about that on our last week about the straight coach industry. Now, a lot of people don't understand what maybe Lucas or myself or a lot of other trainers that we know, how they got to a point that they're at now. And I said, like, if you scroll to the bottom of someone's Instagram feed, Lucas's example, you'll see that he started at Parks. Like, you won't see this, but that's what people see. That's what people see, right? And like what you're saying,
like you just showed up and it was there.
Yeah, and like what you're saying is like, it kind of changed my perspective a little bit when I look at it. Is like when I first started training, I was working 12 hours a day on average, and it was just like make as much money as I can and build. The biggest thing really was like build my name as big as I can. Not really about the money, like the article said. It was just, hey, can I build my name as big as I can? Because I wanted to build something bigger, something that you could look at like this and be like, man, this guy, that guy built some success in this industry. But a way to look at it really is like, what you're saying is like, you could look at it to where I'm trying to make that $1,000 extra so I could set my family up and myself up 30 years, 40 years down the road. Because like what you're saying is 16 hours a day, you know, you could work 4 or 5 extra hours a day, or maybe on a Sunday, which maybe you wouldn't work at night or whatever it is, and make that $1,000. And now all of a sudden, boom, now you can put that money away. And I think there's a lot of strength coaches that either, they just don't really think about it. It's not that they don't do it. It's not that they, whatever. I think we just love this. Training people, being in this environment, being a strength coach, and we don't like to talk about this. But this stuff is so important because, like you're saying, is when you get to 50 and you still got to work 12 hours a day, that's not going to work.
And your shoulder hurts and the hip hurts, right? And
Because you're on your feet all day.
you're on your feet all day and you've done your best to maintain your body. But, and this is this is also something that I promise you is going to happen. You guys are both going to get kicked in the teeth probably twice in the next 30 years. I've been kicked in the teeth 3 times in the last 30. The economy rolls that way, life circumstances, health, different things. And if you're not prepared for it, it can just be ugly. So young guys, man, work hard. Young guys and gals, work hard, save your money, put it away, prepare yourself. So for example, there's a gas station in Texas. It's called Buc-ee's. And minimum wage in Texas is $7.25 an hour. And there's a sandwich board out front. They're constantly trying to hire people at $15 an hour. Over 100% over minimum wage. So me and my wife, we go to Buc-ee's, we each get a job there, making $15 an hour. That's $31,000 a year. Combined, that's $62,000. That is about $5,000, $5,100 a month. $5,100 a month will allow us to buy a house in Texas with a house payment of $2,250. So you can work at a gas station and buy a house. And I would tell everybody, as a young coach, first thing, if they're going to make a chunk of money, start early or buy real estate early. Like, I love 21-year-old people that own real estate. They're 20. I've had many clients, over 2,000 clients, 2,500 clients that I've done loans for. And not one of the college-educated clients has done what I'm suggesting, okay? The two that have done what I'm suggesting, I told them, go buy a duplex or a triplex. They both did that. Then they both bought their own houses. And then one of the guys, who's an air conditioning guy, bought his second home as an investment. And that triplex that he bought, and I think he paid like $400,000, so he had like a $14,000 down payment. That pays the mortgage on all 3 properties.
Wow.
And he might be in his mid-30s, late 30s now. It's a big deal. So then we move them forward to set up the retirement accounts. That's what I would tell young folks to do. But build a habit, build it quick. The other thing I'd tell you is I think most people should read Think and Grow Rich. They should read The Millionaire Next Door and How to Win Friends and Influence People.
Okay.
Super important books, I think, for young folks to read. It will get their mind going, especially if they're businessmen like you that are building something.
So can you put some numbers behind this? Because I think that'll make a big difference, and I can put it up on the screen for the podcast. But if you could just kind of give us some numbers of what might
Sure.
should suggest, I think that could make a big difference.
And I think we talk about, I use this saying a lot. So a couple of simple habits before I run through numbers. Don't buy things you can't afford with money you don't have to impress people you don't even like.
That's great in general.
Okay? So so that your followers know, I've actually purchased a house at auction where a police officer and a teacher owned the house. And he had a 7 Series BMW. She had an Escalade, and they had a Malibu in the boat. And I did not even remotely feel bad because those car payments are a house payment. The car payments and boat payment are a house payment. So don't buy things you can't afford with money you don't have to impress people you don't even like. And the other thing I'll tell you is if you can live today the way others are not willing to live, then you can live in the future the way they won't be able to. Okay? So if we talk simple numbers, and this is $100 a month, $1,200 a year for 30 years, and you're going to earn a 9% return, which is probably on the higher end, a 9% return. $100 a month will garner you about $180,000 in 30 years. Okay. Now, granted, that $180,000 is probably going to purchase about $80,000 worth of modern day or current dollars can buy.
Due to inflation.
Due to inflation. If you were to go to $500 a month at 9%, you'd have $900,000 in the bank. And that's just building the habit. But this, it's like, you know what? I'm going to make a perpetual car payment of $500 a month, but it's going to my retirement account. Okay. $1,000 a month puts you at $1.8 million. If you garner an 11% return, you're at $2.7 million. Here's the difference. $1,000 a month at 9% is $1.8 million. At 11%, it's 2.7. It's a $900,000 difference. If you're rocking this thing and you can afford to put $2,000 a month away, you do it and your spouse or your significant other does. Well, now you're talking about $3.6 to $5.4 million, and it costs you $1,000 a month. So it's that $1,000 7 Series or that $1,000 boat payment or that whatever it may be. Start the habit now, and the numbers become phenomenal. If you're in that situation where you're self-employed and you do have an income number of $100,000 and you're allowed by law to put away $25,000 into a qualified account, that number turns into $5.7 million at an 11% return and $3.8 million at a 9% return. And it's just starting to happen. You're going to spend the money anyway. So maybe, my wife and I, we love sushi, but we can cut that, and you hit sushi 4 times a month. And I don't know, we just don't seem to get out of a place ever for like $75, right? Cut it in half and there's $150. It goes into that qualified account.
And I think we talked off air too, where it's like, well, people might think, well, $1,000 a month, I just can't do that. So, well, what's the cost? But we mentioned, look, the cost is not doing it. That's the true cost, is not doing it. Can you speak to that a little bit?
Yeah. If you want to have children, are you prepared to rely on them to help fund your retirement? And when I say fund your retirement, it's not traveling to the Bahamas. It's name brand, generic, or no medications. It is, do I eat 1, 2, or 3 meals a day because I don't have the money? And most people will pridefully not mention it to anybody because they've made a mistake for 30 years. The cost of not doing it can be catastrophic for individuals. And I've had the cat food lady where we've done things for them because they're to the point where they're almost having to eat cat food because they don't have any money. I hate to say it, but you have to have money to survive in this society. So start habits. Don't go crazy with the thought process. I can't tell you how many people call and said, hey, I'm going to set up these 2 LLCs. I'm going to and do this, that, and the other. I'm like, no. Just start a sole proprietor. Open up a checking account that says Nick Pantuso, and you have your checking account and your real estate income, your commissions or whatever, or your training, it goes into this. And whatever number's deposited at the end of the year, it shows up on the first line of your Schedule C of your tax return. Your CPA will love it. And just run it off of Schedule C and keep it simple, but start the habit. And it's not difficult. Most people can figure it out. And if they all of a sudden have a couple kids, they're going to figure it out real quick because they got other people relying on them. Take a little bit of time, do the research, start the habit. Start the habit.
I mean, the biggest thing from those numbers to me is like what you're thinking, $1,000, not that hard to get to $1,000. You could figure it out if you want to make the commitment to do that. The other thing is like from the 100 to 500 to 1,000, even from the 100 to 500 is a big jump from a dollar perspective.
From a dollar perspective.
It's a big jump. So it's even, like you said, you mentioned earlier, is maybe your first year, you start at that $100. And maybe your goal is in 2 years, I'm going to get to the 500, and in 5 years, I'm going to be at that 1,000, and for the rest of my career, I'm going to be at that 1,000, and then maybe jump to that 2,000 when I get to that point. But when you're saying dollar amounts and I'm listening to, I'm like, even from the 9% to the 11%, like those are drastic changes. I'm sure it's different from even $100 to $250. So it's like you're saying is maybe skip a dinner, change something up in your lifestyle. Because I've seen it, and I've seen it in some of my elder friends, is that maybe they don't have the money, they're prideful not to say anything, but they'll still say yes to something because they want to be a part of the community that they are in or the friends that they have. And I see it even in young strength coaches or young friends that I have, is that you kind of know maybe they're struggling a little bit, but they'll still say yes to go to a really nice dinner and spend $100 at dinner, and they maybe say yes to something else, and it's that money could be going to what you're saying, and it's not that much that you can sacrifice in order to set yourself up for success.
Totally.
It's interesting.
Yeah. You have to create that habit because at some point in time, the bell's going to toll. You're going to have to pay the toll. Yeah, for sure. I do want to mention, like you guys are in the strength industry, you are telling people you got to get after it. Let's go. Let's get it done. And I'm just saying the same thing from a financial perspective. So Ryan Broyles played for, I believe, the Lions, wanted to play for 10 years. Ended up playing for 3 years, had a 1.1 guarantee, but his total contract was 3.6. And he lived on $60,000 a year, him and his wife. They lived on $5,000 a month. Now, even if you have a coach that's only making $60,000 a year, can you live on $4,000 a month instead of the $5,000 a month and start putting some money away for your retirement? That's the key, and it's discipline. I know it's a difficult example because the guy had made so much money, but if you don't dig your well before you're thirsty, it's going to be a long, dry summer.
And I think too, because of COVID, online grew so exponentially in terms of your opportunity to make money online in the fitness industry or in the strength and conditioning industry or training athletes. So, it's not that hard to start an online business and use that money, to put away, or use that money to put into an investment account or something like that. So there are creative ways to do it if you hustle and if you grind and if you're creative and if you really want to make something happen, especially after COVID and the success of online, or creating an online course or just finding a niche industry or a niche topic where you're very passionate about and you're knowledgeable about and you can provide value. And use that money or use that revenue to put away. And you don't have to 100%. Touch your in-person training money or your salary or whatever it is,
I love the word hustle and grind. I love it because you guys have obviously done it. It shows your success. It shows with your relationships. Hustle and grind. And everybody should have a side hustle. I'm 55 years old. I'm a CPA. I'm a real estate broker. I'm a lender, and I hold 4 securities licenses. What's your side hustle? And on top of that, you guys sound stupid, I broker dirt right now.
What do you mean?
I mean, guys call me up. I got 2 calls today. They need to move 70 truckloads of dirt.
Oh, literal dirt.
Dirt, big super tons of dirt. What's your side hustle? What are you doing? What's causing your brain to work and be active so that you can build something for you and your family?
Yeah, and not to be cliche, but this is America, and you can do what you want to do. You just got to put in the work, you know? Not to be cliche, but I really believe in that, you know?
You don't know how many guys that I know that were not born in this country, were born in Mexico, that drive $175,000 trucks. And those trucks, they get paid $350 a load, and they'll do 3 or 4 loads a day, 6 days a week. $175,000 is not a lot of money for that truck. And they're making $1,100, $1,200, $1,300 a day driving dirt. They're hustling.
Yeah.
It is not cliche. This country, you can do anything if you just grind it out.
Yeah.
I mean, and like what you're saying is that this industry is like, go get it, hustle. Like that's part of the strength coach industry, and that's what like a lot of people have a good time talking about. Is that we work so hard, we love it, we push sleds, lift heavy weight, just get after it, don't care about the money, all that stuff. But even if you change that mindset to 10% to focus on you and your finances, it could drastically change the outcome of your later life.
Pay yourself first.
Exactly. Yeah,
Pay yourself
exactly what you
first.
said in the very beginning is that could drastically change.
You mentioned payroll, and you mentioned that was the first thing to do. But how do you do that? What if somebody doesn't know how to do that? As of 3 or 4 years ago, I didn't even know what that meant. What does that even mean? Explain that.
Great question. Okay, and I'm the old guy here. Go on your keyboard and you go to Google and you type in ADP.com.
ADP.
ADP, Automated Data Processing. I think it may have been a Ross Pro company or something way back then. You guys are too young. Go to ADP.com and search there, I want to set up payroll. And there's going to be some local salesperson right here in Westlake Village that you can get in touch with, and you say, look, I want to set up payroll for my company. I don't want to put my wife and my 3 kids. And you may or may not ever meet with them. They may want to come out and try to smooze you to get Jared's business and then to the next person's business. Go to ADP.com or just Google, I need to set up payroll. And there's a plethora of payroll companies you can set it up with. Probably take all of 2 or 3 weeks and you're done, if that.
Even as a sole proprietor.
100%. 100%. Yeah.
Yeah, see, I didn't even know what that was when I started this.
And so what happens is, so you pay your kids $500 a month, that's $6,000 a year. And again, it comes out of your business account and it goes into your checking account, but it shows up as payroll for the kids. And a lot of people will say, yeah, but I got to pay payroll taxes and I got to pay for the processing, the $39 a month. Okay, so be it. So you do this for 2 kids. Now you've written off $12,000 over here in your business. And if between the federal and the state, you're at the 20% tax bracket, that's $2,400 in tax savings, okay? And it costs you $39 a month plus your payroll taxes, so it costs you $1,000 a year. So you've saved $1,400 just by doing this.
Which is not a lot of work to do at all.
No.
Yeah.
No, and it's done all automatically. Every month you pay the kids $500 a month, and you pay yourself $2,000, your wife $2,000, or whatever it may be. You set it up and you let it click. It's a set it and forget it kind of thing.
And you're saying it's basically for the tax deduction purpose.
Yeah. That's what I would do it for. And for the SEP IRA, men and women out there in the strength industry that are making closer to $100,000 a year, that they have it in their own business. If they pay themselves via payroll, 25% of that number, up to $62,000, can go into a retirement account tax-free. That would be the reason that if you're rocking in your business, you want to set that up so you can have a SEP IRA set up. Everybody on payroll gets to participate in it. Everybody on payroll must participate in it. Your kids can't until they're 18, so if it's just you and your spouse, well, now you guys can both contribute to retirement accounts, and it's tax deferred.
I've never heard this talked about for strength coaches, ever.
And would you say going on the payroll thing, is there a certain dollar amount that you would say someone to start that, or would you say start that right away? So say it's a young strength coach is married and they're only making $40,000, $50,000, would you say, hey, set that up right away? Or is there a dollar amount that you're like, hey, try to work toward, hustle harder to make more money so you can set that up? Or is it?
So let's talk about it from that perspective. She's the strength coach. She's making $40,000 a year, and he's a teacher or something. He's got his job. So between the two of them, they're making 80 to 100 grand a year. Set up payroll and put both of you on payroll. And if then you can defer $12,000 for him and $12,000 for yourself. You know what I mean? Yeah, 100% I would. If you're all by yourself and you're making 40 grand a year, no, we'll just set up a simple IRA and contribute the maximum amount, which again I think is $541 a month, and you roll from there. But if there's more income coming in the house, and here's the thing, if you have a spouse and you're both making money, consider your income worthless psychologically. My income is just going to go to the retirement account, and your spouse's income is going to go to run the household, or vice versa. Either way, so many people got caught up with, well, I make this much, and my spouse makes this much, and we use that money for this. Who cares what it's for? Start putting money away. Build the habits. Just create the habits.
And as far as, strength coaches in the private industry too, who have to, be responsible for a lot in terms of they've got to pay rent, they've got to pay insurance, they've got to pay utilities, they have to pay employees potentially. That can all be really, really expensive because that's all business. You still have personal as well. So what's your advice for strength coaches who may own a big, training facility, but they're still living paycheck to paycheck because they have to come up with $10,000 or $12,000 a month just to break even?
Pay yourself first. If you pay yourself first, Robert Kiyosaki, Rich Dad, Poor Dad, get that book. Pay yourself first. If you pay yourself first, you have obligations you got to handle. You will figure out a way to handle those obligations. That's the Rich Dad, Poor Dad theory. Pay yourself first. Well, yeah, but if you're going to worry if FUD, fear, uncertainty, and doubt is going to drive your business, what you have is what you have, right? Would you bet on you?
100%.
Would you bet on you all day long, right? So pay yourself first, and then you'll figure that piece out. And figuring that piece out may just mean I got to go Uber tomorrow night because I need an extra $150 this week for whatever.
Yeah.
Pay yourself first.
Yeah, I think there's in the strength coach industry that especially in the university setting, you may be at a different job bouncing around every 2 to 3 years. A staff could get fired and you're a part of that. So, what about guys that have been to 8 different schools in, 3.5 years or 6 years or whatever? Does that make it harder to invest money, or what about a guy in that situation?
Not in the least bit. And I will tell you, most people not in the strength coach industry will have 7 different jobs by the time they start and the time they finish. Same thing. So if you're bouncing from school to school with staff and different programs, whatever it may be, turnovers of coaches or eliminating a program, which they did to me at Long Beach State after I left, they eliminated the program. So it's funny because I was looking up that strength coach that was mine back in the day when I came here. That money follows you wherever you go, and it's bifurcated. It's completely separate. It's its own silo of wealth, and regardless of how many different ways you're paying into that silo, wherever you go, it's going to follow you. So, questions like that complicate the issue.
Yeah.
Start the habit. Do you know what I mean?
Yeah, I think that's for me, yeah. When you asked the question, that was the first thing I thought was I think a lot of strength coaches, people in general, think about that, the next job, make more money, find the next step, bounce here, bounce there, but they, again, don't think about what you're saying.
It's too short term. They're thinking too short term.
It's I just have to put $500 away. No, I'm trying to do this, I'm trying to do that, I'm trying to do this, versus just making it very simple and start the habit. And like I said, I struggled with that probably my first 4 or 5 years in this industry. It was just
brother, I think we've all struggled with that for sure. Because when you're young, you're invincible, man.
Yeah.
But by the time I was 25, I'd already buried 6 friends, right? So start it, because you just don't know. And whoever you bring along, wife and kids and spouse and kids, whatever it may be, start it so they're taken care of. And for those strength coaches that have spouses and kids, let's also maybe get a little discussion going on a chunk of life insurance.
Yeah, talk about that a little bit.
By the time I was 25, I had buried 6 friends. Last year, I buried 5 alone. And you just don't know I mean, Timmy passed away last year. He fell asleep and didn't wake up. He looked like he could still go on the pitch and step in the net and play. I mean, he was fit and in great shape. He just fell asleep, didn't wake up. If you don't set up a living trust, if you own any piece of real estate, you need to set up a living trust. You need to have some kind of life insurance so that those that potentially you leave behind will be taken care of. And those are just two very important things to do.
How do you set up a trust?
You can do it online. Any attorney is probably going to charge between $1,500 and $3,000. Couple key components is you have a living trust, but you will also have a will. Your will must be a pour-over will, meaning some of the basics are, and I think the number's still 150. If you have assets in excess of $150,000 and they are not in your trust, that goes to probate, which means the court gets involved. They put an attorney on the case. They take a chunk of the estate because everybody gets paid, right? Or if you have a piece of real estate, it must be in the trust or it automatically gets probated. A pour-over will is for everything you don't have in the trust. And you will have things that are not in the trust. You got a Mickey Mantle baseball card, a rookie card. That's worth a chunk of money, right? That's going to go in the trust.
Got it.
You know, that 69 Corvette that's was Grandpa's sitting in the garage. What happens if you picture a pour-over will, all these little tiny assets go into this pour-over will, and everything in that will pours out of the will into the trust.
Got it.
So, important things to have. You can set it up online. I'm sure I've got an attorney that's done ours, $1,500 to $3,000.
And then life insurance. Talk about that a little bit.
For young guys, and what I currently have is I just have term insurance. Because of how I've built my portfolio, it's not necessary to have anything but that. Plenty of money to plant me in the ground and give mama cash for whatever she may need, you know. So even if it's as little as a $500,000 policy, you guys are super fit. I'm sure that most life insurance policies are going to draw blood and they're going to take some vitals, and your blood pressure is going to be low, and you're going to be super clean, and it's probably be a very low premium. It's worth doing just to have the peace of mind, and it's the get hit by the bus theory, whatever it may be.
Yeah, because a lot of guys who are in the private industry, they're their family's income. They have to work. If they don't work, they don't make money. If they don't work, they don't eat. So that part is, you know, adds a lot of stress onto the job and onto your mind as well.
That's really stressful. Imagine that and thinking that, man, if I pass away, what are they going to do? I am the sole provider, right? If she's been out there busting her hump and building this, she's got a book of business of a couple hundred clients, and he's at home and he's raising the kids and he's not worked and she dies. Well, what skill set does he have, right? And so I think life insurance is a key component. Everybody should have at least a chunk, at a minimum, to pay off the house, right? Again, air, food, water, and shelter. Doesn't matter that you have, you know, Nikes on or Asics on, or you drive a BMW or a pickup truck. It's air, food, water, and shelter, right? That's the key.
Yeah, I mean, I think that's another point of, like, you said attorneys, $1,500, $3,000. That investment might be worth it to have someone do it for you. I think a lot of times, especially, I'm going a lot based on like my career and what I've thought, is that like when I was making money early on, I just wanted to keep all that money. I wanted to put it maybe just right back into the business, which I don't think is a bad thing, but like I never wanted to think about retirement. I never wanted to think about life insurance. I never wanted to think about any of those things that are obviously very important. They're never talked about in this industry. Like I don't have any buddies, maybe besides Lucas and one other buddy, that we have these conversations about, and they only started probably 4 or 5 years ago, which is, you know, I wasted 3 or 4 years, but I learned a lot from that. And now I can be in a position now to have these conversations and understand and maybe help younger strength coaches go on and say, like, hey, you know, put $1,500 away so you could go talk to attorneys, so you can set this stuff up for you, because that's your life. It's really important for you, your family, whatever you got going on. You know, stop paying something that you have so you can invest your money into an account. Like, those type of conversations are huge to have for this industry, to, you know, push it forward so people can stay, great coaches can stay in the industry and they can make enough money to provide for their family. and retire at a decent age and still have a good life to be able to run around with their grandkids or their kids or whatever. Yeah, 'cause it's hard.
Or just travel.
Yeah.
Or do volunteer work, whatever it may be. But you had made the point up at the beginning, what's the cost of setting something like this up? And then the immediate question is, well, what's the cost of not setting it up, right? So $1,500 to $3,000 for a trust. Should you have a piece of real estate and you don't have a trust, the cost is going to be 10 to 20 times what the cost of setting up the trust would have been. So 10 times $1,500, 15 grand. 20 times $3,000, it's going to cost you between 15 and 60 grand to settle that with the courts.
Which is a huge headache.
It's a huge headache.
Yeah.
Huge headache. Not to mention that you should have a health directive, a DNR or some kind of health directive, durable power of attorney, so that should something happen, you can make decisions for one another. Yeah. So all this stuff, it's we talked about a lot of stuff and it can be complicated, but it's really super simple. Set up the account, start the habit.
And maybe to shift gears a little bit and just talk about taxes in general. What are some things that, a strength coach who knows nothing about taxes, what does he need to do to make sure he's maximizing his deductions, maximizing his income, planning for trying to open a facility or training facility in 2 or 3 years? What are things that, tax-wise that you would, just talk about?
So I talk about this, most of this part of the conversation is all in relation to eventually purchasing real estate, right? If you want to create silly wealth, you purchase real estate, or you put big numbers away early and for a long time. If your wife wants a house, you purchase real estate, okay? So from a tax perspective, all of this equipment in here, this couch has probably got a 5-year useful life in the IRS guidelines. And it cost $1,000 5 years, so you're going to depreciate it $200 a year for 5 years. Or there's a code section 179 where you can depreciate the whole thing in 1 year, and you write it all off. It's a matter of not saying I have furniture expense and you're expensing this couch. You have a furniture asset and you're depreciating the expense of it.
That's key.
It's huge because this $1,000 that reduces your income, I can add it back to your income for purposes of financing a piece of property. The other thing is if you have a Schedule C, you have your car payments and your oil changes and your tires and your brakes and all that. On the second page of the Schedule C, and I'm going to get this wrong, but I'm going to say it's around line 40, you can actually fill in the amount of miles you drove and take, let's just call it, it's 54 cents, I think, but let's just say it's a 50-cent mile deduction and you did 17,000 miles. You did 20,000 miles, simpler math. 50 cents on the dollars, you can write it off taxes of $10,000. But for purposes of financing a house, as a lender, I get to go back and say, well, that $20,000 miles, I get to add back 25 cents a mile. So now, even though you took the 100% write-off, I can give you an extra $5,000 of income. And the last thing I would tell you to do is don't write off meals and entertainment. The tax code says that if you write off $1,000 on your tax return, you're only allowed to write off 50 cents on the dollar. So every underwriter in the nation knows that if you write off $1,000, you spent $2,000 in meals and entertainment, and you only got to write off $1,000. Well, they know your cash flow was down by $2,000, so they hit you for another $1,000 loss. I would just say categorize it as something else.
And it increases your purchasing power in terms of real estate.
In a huge way, yeah.
In terms of qualifying for loans.
Qualifying for a loan. So it takes these expenses that you took that are, some are cash, some are non-cash, and it allows you to add back a fraction or all of it to your income. You made $100,000, you depreciated $10,000, you paid tax on $90,000, but I still get to give you a loan based on $100,000.
Right. Or you spend, $10,000 or $15,000 developing an online business and filming content and things like that. That could be an asset, right?
It is an asset, 100%.
Yeah.
everything we're doing today, this microphone, these chains, everything here today is an asset that you can write off. And so depending on your tax bracket, instead of paying $100 for a chain, tax affected, you're paying $70 for it. Absolutely, 100%. Anything you do, making T-shirts, sending out flyers, the photocopy, the printer, you name it, everything becomes part of it. And what most people will do is all the cell phones will be through the business. The car payments will be through the business. And you don't, here's a big way. Let's just say you have a $500 car payment. And the car payment's in your name and the business name. Don't ever write a check for the payment out of your personal account. Make sure it always comes from the business account, even if you got to put money in that month to make that payment. That will not be counted against you for purposes of qualifying for a home. And I tell all my self-employed clients and even people that are not clients, look, if you're thinking about buying a house, I'm happy to do the loan for you. Before you file your tax return, let me see it. I want to see the return. Because the CPA is going to make you feel good that he saved you money in taxes. Whereas if I just reclassify some things, I might be able to get you an extra $75,000 to $150,000 in loan proceeds.
Which could make a big difference.
A huge difference. Massive difference.
In the property that you get or the payment that you're making.
Or the neighborhood that you have to live in versus what you could have lived in. You saved $4,000 in taxes, but if you hadn't done that, I could have you living in a whole nother neighborhood. But you saved $4,000, you saved $4,000. You know, those are the kind of conversations I have.
Yeah, and that's powerful, and I don't think strength coaches think like that. That's just totally different than the way that we think.
Yeah, well, I'm a different person too.
Yeah,
I'm a little strange that way.
Yeah, I mean, it's just the conversation that we've had today is you don't ever see that in strength coach podcasts. You don't see that in. I've seen a couple, but not. You know, it's almost like this should be like a bit. This would be classified as a business podcast, but we are business owners.
You're business owners.
We're not just people that just train people all day and talk about reps, sets, intensities, all the cool stuff that we like to talk about. But like, we are also business owners. And, you know, if you don't focus on that and take some of these little things that, like you said, are very simple if you break it down and build the habit, you know, you might not be a business owner in 10 years, 12 years, or you might have to have another business just to afford to do this.
Just to live.
Which you love to do. You know, which we've seen probably plenty of times, which makes us sad, which one of the reasons why we're trying to do this and have these type of conversations is to just bring a light to it and help some younger strength coaches, or what Lucas brought up earlier, as an older strength coach that maybe just didn't learn this stuff ever and just kind of has been just training people and loving his life.
Totally.
Yeah, and that's why I think there's not a ton of bigger training facilities that are successful, because it's hard to do it. You could do it for 2 years, you could do it for 5 years, but it's hard to sustain it. So maximizing your tax saving and your financial planning, I think, is really important as a business owner first, and as a strength and conditioning coach or a trainer second.
Try to develop the habit to pay yourself first. Einstein said the eighth wonder of the world is compound interest. Those who understand it will make it work for them. Those who don't understand it will work for it. So you can either have it work for you or you can work for it, but somebody is working in the compound interest calculation. And that's what this whole retirement thing is. Yeah.
Well, I appreciate you taking the time. I think we had a great discussion. I hope that strength coaches are going to take this to heart and make a change. You know, I think there are probably 5 things that you mentioned. Do it right now. Do it right now. Do it right now. That's easy to do. You know, it doesn't take a ton of money. It doesn't take any talent. You know, you don't have to be that smart. Just do it. You know, so I appreciate you taking the time.
For sure. I appreciate you guys having me, and I enjoy this stuff. Yeah, it's great. I got to give back. Yeah.
Cool. We talked a second though. One finishing is there any last kind of like advice? I know we talked off air a little bit about books. Is there anything, you know, final statements that you want to give to younger people that are tuning in? I know you mentioned some stuff off air, so I want to give you opportunity.
I think Rich Dad Poor Dad is an insane book. Robert Kiyosaki talks about the cash flow quadrant, and I'm not going to go into that because I think everybody should explore that. And you can even just pull it up on YouTube. So Rich Dad Poor Dad premise: one his buddy's dad's a store owner, and his dad's a highly educated professor, and his dad was a broke, highly educated professor, and this other guy's dad, who brought him under his wing, taught him about business and cash flow and investing in business and investing for the future and letting your money work for you. So that, I think, is big. I'd say just get after it. Get your kids on payroll, buy real estate. And something that's interesting, I think we talked about, I was going to tell you this. I've been collecting a W-2 since I was 12. When I was I started the 6th grade with the same shoes I ended the 5th grade in. My dad put 4 of us through 48 years of Catholic school, private school. He left the house every day at 5 and he was home every day at 4, and he worked hard, but we just didn't have a ton of money. So I got a job washing dishes at a local golf course. Mrs. San Jose hired me and paid me a W-2 such, this is stupid. She hires me, and I'm 12. I turn 13 in December. In January, I get a W-2. Well, we know what that is. How many 13-year-olds know what a W-2 is? So back then, you did your tax returns. You got a booklet from the state of California, from the federal government. It was all perforated, so you pulled your tax return out, and you filled it out, you put an envelope, and you sent it in. So my mom made me do my tax return. So I literally said, she said, whatever it asks, you just do. First name, pretty easy, Nick. Last name, Pantuso, D, middle initial. And it took me about an hour to do my tax return. And man, I was standing in the tall grass because I had like a $300 refund. I had made like $1,800 or something that year. I asked my mom what she paid to do her tax return. It was like $19. And making like $2.35 an hour, I'm thinking if I could do a tax return in an hour, I can make $19. That's when I made the decision to be a CPA. Now that is stupid.
That's hysterical.
That's dumb.
That's
is
hilarious.
dumb. Yeah, in the 7th grade. So, and then my mind goes, and so I hustle. I love this stuff. I was up at 6 this morning, made a phone call to a client. Phone's been blown up because guys want to move dirt. I can do all the things I need to do and still go move dirt because it's fun. So.
Cool. Well, I appreciate you taking the time.
You guys are awesome. I appreciate what both of you have done for my family.
Appreciate it.
Working everybody as hard as you've worked.
Yes, sir.
That's awesome.
Appreciate it.
Thank you.